All right, diving right in. Today we're taking a close look at the Spokane industrial market, trying to get a handle on what's happening right now. Early 2025, just getting started right. And we've got this industrial market report fresh off the press, April 2nd, 2025 to be exact.
Yep, hot off the presses.
So, goal for today. We want to figure out what's going on in Spokane, specifically in that industrial sector, what's changed, what happened in that first quarter of 2025.
Yeah, exactly. The first quarter is always interesting, kind of sets the tone, right? And this report is going to help us break it all down. Should be fun.
Okay, so let's dig into some of these numbers.
Let's do it.
We've got some year-over-year figures, but I'm really curious about those Q1 specifics, starting with deliveries. 799,000 square feet over the past 12 months, but the net absorption, meaning how much space got filled minus what went vacant, is way lower, only 71,100 square feet. And then looking at the end of Q1, vacancy sitting at 6.4%. Rent growth, barely budging, just 0.3%.
Yeah, you hit the nail on the head there. What's interesting is that last year was the first time in 13 years that Spokane saw negative net absorption. That's a big deal. And now, even though Q1 is positive, it's still pretty low. So demand is definitely weaker than the new space being built. For anyone looking at industrial space in Spokane, this could actually be a good thing. More options, maybe some better deals to be had.
Interesting. Makes sense. And when you look at the bigger picture of supply and demand, it really highlights that contrast you're talking about.
Yeah.
Net absorption over the year is low, but we've had tons of new constructions, especially those big logistics centers. Like the 12-month trailing absorption is around 150,000 square feet. Compare that to the 5-year average of 740,000 or even the peak of 2.4 million. That's a huge difference. I'm curious, how much of that new supply hit in Q1 specifically?
Well, the report gives us that overall number for the year, but the vacancy rate tells the story. That jump from below 3% a couple of years ago to over 6% now in Q1. That's the impact of all that new space. Even if Q1 didn't see the most deliveries, it's all adding up, Supply's just outpaced demand lately.
Right. So more space available. Of course, rent growth is going to slow down. That 0.3% year over year is tiny compared to what we've seen in the past. Any clues from Q1 about where rent might be headed next?
The report's forecast is actually predicting negative rent growth for the first half of 2025.
Oh, wow.
Yeah. Then they think it'll pick back up later in the year, but for now, that higher vacancy from Q1 is going to put downward pressure on rents. And it's worth noting that Spokane's rent growth over the past 5 years hasn't been as strong as the national average. Looks like that trend might continue based on this Q1 data.
Okay. Now, new construction is a big factor that could change things up, right? The report says there's only 220,000 square feet being built right now. Is that a slowdown from what was happening before, or are developers just being cautious after seeing those Q1 numbers?
It's probably a bit of both. That 220,000 is really low. It definitely signals that developers are pumping the brakes a little bit, seeing that softer demand in Q1 and that vacancy rate creeping up. Slowing down new construction could give the market time to absorb the empty spaces, right? And the report does predict that vacancy will peak around now and maybe even improve later this year.
Fingers crossed. The report also mentions some interesting stuff about leasing activity over the past year. Any big leases signed in Q1 itself that might signal a change in demand?
Well, there was one huge lease in West Plains, 560,200 square feet, signed in Q1. Yeah. So even though the overall absorption isn't that high, a deal that big happening in Q1 shows there's still some serious demand out there. Plus, there were other examples over the last year where absorption was strong, like West Plains Warehouse and Spokane Business and Industrial Park. Those are areas where demand seems to be holding up pretty well.
Good to hear. So let's break down asking rents in Q1 specifically. Overall, it's $8.85 per square foot, but of course it varies depending on the type of industrial space. Logistics is a little lower at $8.48. Specialized industrial is sitting at $8.92, and then flex spaces are higher at $10.65. Did Q1 shake things up in terms of those segments?
That's a good question. The report mentions that overall year-over-year growth is just 0.3%, but it doesn't give us specific Q1 to Q1 comparisons for each segment. Still, those current asking rents give us a good baseline for where things stand right now, and it'll be interesting to see how they change over the next few months with that rising vacancy we talked about.
For sure. What about those two properties that are currently under construction? Almost 217,000 square feet total, and the report says most of it's already pre-leased. Any updates on those projects from Q1?
Not much new info, really. King Beverage, the bigger one at 205,000 square feet, is still on track for completion in October 2026. The smaller project at 3830 Olympic Avenue should be done by May 2025. The fact that so much of that new construction is pre-leased tells us that even though developers are being careful, there's definitely still demand for the right kind of space, maybe build to suit or prime locations.
Makes sense. Now, switching gears to the sales market. The report mentioned a shift towards smaller properties being traded between private investors. Anything happening in Q1 that reflects that trend or gives us a sense of what's going on with pricing?
There was one sale that caught my eye, Hana 110 Arrow Road, sold for $20 million in Q1. But the interesting thing is, it was completely vacant when it sold. Yeah. And it went for $36 per square foot. So maybe investors are betting on the long-term potential of a good location, even if it's empty right now. Overall sales volume for the past year is down compared to the 5-year average, and prices have been pretty flat recently. But that Q1 sale shows that vacancy is still playing a big role in what people are willing to pay.
Absolutely. The overall sales stats for the past year show an average cap rate of 7.3% and an average price per square foot of $70. But that vacancy at sale is really high, averaging 52.5%. Do the Q1 sales we know about line up with those numbers?
That Arrow Road property at $36 per square foot is way below that $70 average, which makes sense because it was vacant. But we'd need more Q1 sales data to say for sure if those overall averages are changing. Still, that one sale shows us that vacancy is a huge factor when it comes to pricing.
Definitely. Now, we got to consider the bigger economic picture in Spokane, right? The report mentions that GDP growth in 2023 was actually a bit higher than the national average. Any clues from early 2025 about whether that's continuing or if there's been a shift that might be impacting the industrial market?
Good question. The report does point out some signs of the economy weakening lately, even though there's been job growth in some sectors, and that housing affordability issue is a concern. Rents and home prices are going up, but incomes are still below the national average. People are moving to Spokane more slowly now. All of that could end up affecting the industrial market down the road, but the report doesn't really give us specific Q1 economic data beyond those general trends.
Okay. Now, Spokane has a bunch of different submarkets, each with its own dynamics.
Sure.
Any big changes in vacancy or rent in specific submarkets during Q1?
West Plains is still leading the pack in terms of new construction, mostly because of that King Beverage project, and it also has a much higher vacancy rate than some other areas. The report doesn't give us detailed breakdowns of Q1 rent and vacancy changes for each submarket, but those overall trends we've been talking about are probably playing out differently in each area.
Makes sense. Last but not least, let's drill down into the sector-specific data. Logistics has seen a ton of new construction. What's the Q1 story there in terms of supply and demand?
Well, it seems like the increase in supply has been most noticeable in logistics, which is a big reason for that overall vacancy jump we saw in Q1. We don't have specific Q1 absorption numbers for each sector, but the trend of deliveries outpacing absorption is probably most obvious in logistics.
All right, so zooming back out and focusing on Q1 2025, it seems pretty clear that the Spokane industrial market is going through some changes. We're seeing the effects of all that new supply from the past few years. It's finally catching up to demand, which is why vacancy is up in Q1 and why rent growth is slowing down.
You got it. The Q1 data really confirms that the market has shifted. We've gone from super tight conditions to having a lot more space available. That big lease in West Plains is a good sign, but overall absorption isn't strong enough to balance out all the new supply just yet.
Yeah, it's fascinating to see this kind of reversal after such a long period of strong growth. And the fact that different submarkets and sectors are performing differently just adds another layer of intrigue.
Absolutely. So here's something to think about. Given this shift we're seeing in Spokane's industrial market in early 2025, what do you think businesses operating in this market need to do? Should they change their real estate strategies now that things are different? Is this just a temporary blip, or are these Q1 trends a sign of bigger changes on the horizon? That's the question.
Lots to consider. Thanks for breaking it all down.
My pleasure. Always fun to dive into this stuff.